Happy New Year, everyone. Today we're going to dive in and discuss my market and investing predictions for 2026. These will be sort of my assessment of what I believe will happen in the grand scheme of things, some of what are the positions that I hold, and then I will save some other stuff for a little bit later on, which is what I would kind of define as sort of the free money trade that is out there. Obviously, these things are somewhat speculative. The crystal ball is always broken. One can never be too certain of themselves in predicting the future. This being said, it's a fun exercise to do. And I think it's really useful, for me anyway, to document not only what it is that I think will happen, but why it is I think that will happen. And so I will also summarize a little bit about what happened in my portfolio over the last year and what things kind of played out, what didn't, some of the lessons that I learned based on the things that have worked worst for me, I guess, over the last little bit. And so let's dive in and discuss it now. Before we do, if you haven't already hit the subscribe button, hit the little notification bell. Welcome, I am Michael. This is Offshore Citizen. Mostly we talk about international corporate structuring, so how to pay the lowest legal amount of tax possible. We do super complex, sophisticated international tax structuring for people with complex, businesses in multiple different countries, etc. But also for people who want to stay in their country, sometimes digital nomads, investors, etc., who require some for stuff, as well as helping people to relocate to other countries. And we do both the design and strategy around that, as well as the implementation, helping with banking, helping with all this stuff, and maintaining the structure afterwards. So that's that. If you're interested in it, please reach out to me. You can book a call at comedy.com/Michael-Rosmer, link in the description below, or send a message through offshorecitizen.net. Okay, so quickly just recapping the year and a little bit of what inspired this video. I have a good friend who he and I talk investing quite a bit, and he had kind of made the observation from some conversations we'd had the previous year that you sort of could tell what the themes were for 2025 by the start of the year, and then just sort of play those themes. And I think the two that we particularly were calling out were gold and European, but specifically German defense contractors. And those were sort of trades that were kind of obvious coming into 2025. I actually played neither of them. So a lot of my mistakes, I would say, were errors of omission in this year. But, is what it is. For the record, kind of my overall, so on the stock side of my portfolio, anyway, my portfolio ended up a little over 30% for the year. So beat my target as well as beat the market, which is good. But was down from the highs. I was up about 50% for part of the year. And certainly I have some friends and people that I know who did much better than I did. And we'll see how we each do year after year. What you do in any given year does not matter particularly well. I happen to have done quite well over the last 3 years, but that doesn't, I could all go to hell next year, right? So hopefully the predictions we're talking about here, one should not be too overconfident, one should not gloat, etc. One should remain fearful of being screwed by the market, because that is what the market likes to do. Anyway, so those were kind of the obvious trades at the beginning of the year. They were sort of first order trades, and was something that it was an interesting lesson for me. By the time, so the German defense contractors started to do well, and I said, oh, it's probably too late because it's a first order trade. And it turned out first order trades did really well. There's a number of these first order trades that took place. Normally the thesis is that the market has already priced it in. So by the time you hear about it and get excited about it, the market has already moved. That proved not to be true. And I found that quite interesting. It was, just sort of counter to what the conventional wisdom of these sorts of things would say, in my view. Another thing that happened was, so it was the middle of December, I think it was December 16th or something, 2024. Trump had been elected and the market was just super euphoric. I remember opening Yahoo Finance, seeing all this like American exceptionalism narrative. And I was like, I feel super uncomfortable with this. Now, what I should have done was just sold everything at that point in time. I would have avoided all the tariff downturn, etc. I did not do that. So again, error of omission. Worked out okay, but I could have done much better if I had behaved accordingly. And but one of the things that I did do was the US dollar was like spiking, and I was like, this is nuts. And so for context, I have mostly held assets in US dollar equivalents for the last number of years because the US dollar has been in a bull market. So I would have clients pay us in US dollars, my investments would be denominated in US dollars, et cetera, et cetera, et cetera. And I kind of came to the conclusion that I thought the US dollar trade had played itself out and that we were going to go through some protracted period of downturn. Currencies tend to go through long-term trends, okay? And I had a little thing where I posted, there's this guy, Santiago Capital. I've talked about him, Brent, who has this dollar milkshake theory, and I tend to believe the dollar milkshake theory. What I think is maybe a little bit missing about the dollar milkshake theory is that can be true in the long term while still experiencing meaningful periods of downturn within that longer uptrend, right? And so anyway, I don't think that it's a good idea to fully get yourself out of there, but the way that I decided to sort of hedge that was, first and foremost, I decided to buy assets that were Canadian dollar denominated. Now, it helped that I had some very good quality investments that I was able to go into at that point in time. And so this was like, I never suggest, for me anyway, I never want to speculate on currencies directly. I think that it's too easy to be wrong. You lose on the currency conversion each way. So it's a bad idea to say, oh, I think XYZ currency is overpriced, so let me buy another currency. No, what I would rather do is I'd rather buy a quality asset in that other currency and then take that quality asset and gain the exposure to the currency through that quality asset. That way, if I'm wrong, at least the quality asset is sort of mitigating some of my risk. And so that's what I did in this particular case. I converted, and then why Canadian dollars? I wasn't necessarily inherently bullish on the Canadian dollar as compared to a bunch of other currencies. And in fact, from a pure currency standpoint, it would have been better for me to buy into euros or GBP or something like that. But the way that I look at it when I'm looking at currencies is that I don't want to be in a position where I'm buying a currency that I am not likely to spend somewhere else. And so, for example, Swiss francs have been a traditionally strong currency. You definitely could have bought the Swiss franc this year as well and done well relative to the US dollar. But the problem with that is I don't spend that much time in Switzerland and I don't spend that much money in Switzerland. And so if I'm wrong, what do I do with it? So because I'm from Canada, my view is essentially, well, when in doubt, if I'm wrong about the currency, I can always buy my brothers a house. Great. That's like, I can go and do that with the money and I don't have to feel like I lost out because all the assets were priced accordingly. And so this is what I did. I put a meaningful share of my overall liquid portfolio into those assets. I also, throughout the year, did a bit of buying euro-denominated assets. We'll circle around to what those are a little bit later on. And a very, very tiny exposure, super, super small as I share the overall portfolio, just to kind of test some things out in yen-denominated assets. So that was kind of the distribution that we were talking about. And so how did that go? Well, I exchanged at about 144 to 1 in the US dollar to Canadian dollar, and it ended the year at about 137. So, it was about a 5% lift on what turned out to be a really good investment in general. So great. I just got to multiply my Canadian dollar holdings in USD terms by an extra 5%. Perfectly well, perfectly happy with that, and quite satisfied with that particular exchange. Going forward, I believe that the Canadian dollar will strengthen relative to the US dollar in 2026. So by the end of 2026, my expectation is that it will be below 136. How far below? Very hard to say. I'm not smart enough to make those types of calls. I expect that this will be somewhat of a trend. And I want to talk a little bit over this video about some of the reasons that I think that will happen, because this is part of the big picture. So I've struggled a lot with trying to reason about currencies over the years. I feel like I do a bunch of hard money lending. I understand that very well. I understand how to kind of evaluate the risks. I understand what the returns are, et cetera, et cetera, et cetera. When I do real estate, I have a fairly good understanding about what's going on there. As I go into businesses, I've done a lot of business in my own life, and so I have a decent understanding of the mechanics. Obviously, every business is individual, so there's certain businesses that I don't have a deep understanding of. And so certainly, there's some spectrum, but the mechanics, the underlying piece around business, I have a decent understanding of. When it comes to currencies, and this actually would go for commodities as well, I tend not to have a deep understanding of what is my mental model for what drives those prices. So I've tried to spend a bunch of the time in the last year to think about why was it that this would happen. At the time when I made this bet, the idea was essentially simply that there was euphoria in the US dollar, was just overbought, and that there would be some sort of a mean reversion that would take place. Now, some of the things that I've observed that I believe will continue to drive that trend over this coming year, because normally I'm not particularly bullish on Canada. But I think a few things are true. One is the US is having downward interest rate pressure. Now, obviously, interest rates are not everything. You have countries with super high interest rates, with super weak currencies, right? And so you can't entirely look at that, but it is an influence. Another thing that is happening is you have the Bank of Canada signaling the counter of that, which is they may raise interest rates. And we've seen this a little bit between Japan and the US, where we've seen some degree of unwinding in the yen carry trade. And I think global carry trades in general, similar sort of thing, if you look at the disparity between the euro and the US dollar over the course of the last, like, really in excess of 10 years. And so similar sort of effect here. The general pressure of higher interest rates in Canada, lower interest rates in the US on a relative basis means there's a little bit of pressure away from the US and towards Canada. It's not a deterministic thing, of course, it's just an influence. The next thing that I think is fairly important is you're going to be in a situation where we've seen metals do really well. So one of the big themes clearly for 2025 were metals. And so it started with gold, but then you had silver. This was another error of omission. I've literally talked to people. I messaged the CEO of one of our companies, who's a very good trader, and I had mentioned it to him, and I did not take that trade. So missed out on what was a very good move. A bunch of people that I know in some of the investing groups I'm in, et cetera. It was, their best trade of the year. Wonderful. But you had silver take off, and then you had platinum, palladium, copper. A bunch of these have done really well. So I tried to do some research and understand whether I believe that's sort of a sustainable trend, or whether it's just kind of hype driven in the halo of gold, et cetera. And I've kind of come to the conclusion that you are likely to have sustained higher silver prices, gold prices, and copper prices. In general, the kind of precious, semi-precious metals, I think they will sustain higher prices. And what does that mean? That's going to inform a bunch of my view on what is happening in the world in this year. Because those prices are going to sustain high, and what I'm not saying, let's be very clear, I'm not making a statement that they're going to produce incredible returns in the next year. That's not necessary for this. What is necessary is that because they're high, you have all these miners who were, not making such much money. And when the price of the commodity that they're mining doubles, their costs were being basically the same. You're suddenly in a situation where now you've got a lot more profit margin for them. When there's a lot more profit margin, what is the result? They're going to go and they're going to expand mining operations. And because Canada is quite a natural resources heavy country, that's going to mean more money flows to Canada. I would expect something similar to happen in Australia. I would expect the Australian dollar to strengthen. South Africa is a good mineral heavy place, but there's a whole bunch of other problems there. So again, one should not take this to believe that this in itself is indicative of outperformance of the currency. It might be, but it's just a pressure, right? This is like a series of pressures that are stacking on the directionality of given currencies. So that's kind of the next one. And along with this, I think will be places like Chile and Peru. So these countries as well are going to benefit from that move, which I'll circle around to in a second. So that's another pressure on the Canadian dollar. An additional pressure that I expect to see is, I believe it is very likely, obviously, again, you shouldn't have to hang your hat on it, et cetera, but I think it's very likely that the Trump tariffs get overturned by the Supreme Court. And if this happens, what that would mean is you would have, it would be stimulative, because they'd have to refund hundreds of billions of dollars of collected tariffs. So that's point number one. And point number two is you would be in a situation where that would quite favor Canada, because Canada's hurt by the tariffs between Canada and the US. So that would mean more money going into Canada to buy goods and services in Canada. So these things are all generally positives. And some simple examples of this would be what has happened with steel prices and cement prices in the US. They are quite a high above, say, the Chinese prices. I did some steel business back in the day with casing and things like this for drilling. And so I have a little bit of understanding about how there are some quality differences and things that happen on the Chinese side. So it's not necessarily apples to apples, but broadly speaking, the price of steel and cement are much higher. We're talking about, in some cases, about 3 times higher than in China per, say, ton, et cetera. And that's just bad for housing prices, et cetera, but it also means that there is an opportunity for places like there's cement mines in Canada to export to the US. There's some delta that can be captured in areas like that. So these are all just reasons that money would flow into Canada relative to the US, which is going to be bullish for the Canadian dollar. So I think these are kind of my three main things that I think are likely to drive that. Then there's reflexivity that kicks in. There's all this other stuff that tends to happen. So that would be my prediction on that currency. And in general, I would expect some other currencies as well to experience a similar thing. I gave an example of the Australian dollar as likely benefiting from this trend because it's a heavily mining-driven economy. Notably, I would say I think the S&P 500 will probably not perform especially well this year. I'm not prepared, one of the tendencies that exists in the world is we as humans tend to be overly confident and overly certain on the things we say. And this is why Ben Graham would say that if you were to sum up all investing wisdom in 3 words, it would be margin of safety. So there's a great book, if you get a chance to read it, called Brain Rules. It's a variety of different things we know about the brain. And they do an interesting test in that book discussing how if you give people basic questions, so here's kind of how the game works. You would ask the person, all right, how much does a Boeing 747 weigh? And your job is to place a range, not a specific number. And the interesting thing is it's very easy to win this game. They ask, I think it's 7 or 10 questions or something like that. It's very easy to win the game simply by ascribing a very wide range. And people don't get 100%. In fact, they often score quite low. And the reason is because they tend to narrow it much more than they should. And so I will not make a statement of whether the S&P 500 is going to be up or down, but I do think that it will perform quite a bit worse than it has in the last 3 years. So we essentially had 3 years of really good performance in the S&P 500. Historically, you don't exceed that. It's very, very rare you get 3 consecutive years of in excess of 20% growth, and you've basically had 3 consecutive years now. So, but there are some specific reasons for that. It's not just the number of years. It is also the fact that the index has become really, really top-heavy. You have the hyperscalers, companies like NVIDIA and Microsoft and Apple and Google, et cetera, taking up this really large share of the overall index in weighting. And what that means is if they don't run a bunch, then it's very hard for the index to move meaningfully. My belief is that you've essentially had them play out more or less as much as they're going to play out in this time period. So these are all high quality companies, right? Let me be clear on that. Google, Microsoft, NVIDIA, et cetera. Like, these are great quality companies, but they've run up a lot. There has been this whole AI hype cycle. Now you're going to see the consequences of really massive CapEx, which probably in a lot of cases doesn't generate that good ROI in the short term. You have to kind of pay for it before you see the other side. Now, there are some advantages, of course, because the tax laws were changed where they can get 100% deductions and things like this. So, there's a fair piece there. But in general, I think it's just kind of exhausted itself. And actually a bunch of my thesis is some of these things just kind of exhaust themselves. Not because there isn't something real there. It's just it can only go so far. There's enough people in, there's enough hype, there's enough all these sorts of things. And so I don't think they will run much at all. In fact, in some cases, you could have some sort of a pullback. And in that situation, the others need to the rest of the market needs to disproportionately compensate to the upside in order to lift the overall index. And so I would expect some compression in that regard. Compression meaning the delta between the top few hyperscalers and the rest of the index. I'd expect some degree to which that sort of mean reverts. And I would also expect that you will find money going somewhere else. And so the question is, where does the money go? Does it go further down the risk curve? Does it go into emerging markets? Does it go into some sector-specific things, such as related to mining? That would be an interesting possibility, right? It could be any of those places. So that's sort of the S&P 500. I would expect that the interest rate pressure that is downward in the U.S. will probably continue. You will probably see lower interest rates by the end of 2026 than you do today, at least on the short end of the curve. How much it translates to the long end is a little bit less clear. So one can speculate there. I think that probably won't be like massively significant though. So I think a lot of what's going to happen in 2026 with some of these, and I would just throw interest rates, I would throw oil prices, and I would throw inflation all into this basket, is there just won't be that much change. So Could inflation be a little bit higher? Sure. Could it be a little bit lower? Sure. Is it going to be massively higher or massively lower? No. Could oil prices be a little bit higher? Sure. Could they be a little lower? Sure. Are they going to be massively higher or massively lower? Probably not. So those things are probably more or less in the range that they're in. Notably, do I think that we will see a rollover in things like, so we basically had precious and semi-precious metals do quite well. Notably, things like iron didn't do well, nor did lithium, etc. Why was that? Well, I think you can kind of look at what were some of the build-outs. So I was mentioning that I think that you'll have some sustained pricing on the side of copper and silver in particular. Okay, so those are the two that I want to specifically highlight. Where is this coming from? Well, silver has had shortages for the last while, and it is really needed in solar panels. I think the solar panel build-out is going to continue. I just think that the economics are such now, combined with a variety of different other factors, they're going to drive a lot of solar panel production. You're going to need the silver. That's not going to go away. Similarly, copper is the electrification trend. We need a lot of it. I don't think that's going away. So I believe that generally those prices will remain elevated. They could well go up more. They could pull back a little bit. They could, vary around that. My thesis is not based on trying to be too precise about that. I think usually you shouldn't try to be too precise. I think usually you should be able to be quite coarse in your approach and still have big wins. Otherwise, you're going to end up getting it wrong way too often. So that would be the general idea. Notably, I think that the AI trend has largely played itself out. And what do I mean by that? I do not mean that AI is going away. I don't mean that AI is not going to be significant in the future. That's not what I'm saying at all. What I'm saying is that the hype and run-up in valuations has probably reached a peak. So OpenAI raised their latest round at like $500 billion. I doubt if they will raise a round at a higher valuation in the near future. I don't think 2026 you will see them raising at a higher valuation. I think they'll be lucky if they can raise at that valuation again. And they may just have to push time out, or they may end up in a situation where down the road, things are not going as well as they'd hoped. There's too much competition, whatever. And as a result, you end up having to do a down round. Who knows? You have companies like Thinking Machines, which was a girl who was formerly high up in OpenAI when started that. I think they were raising money at like a $40 billion valuation or something. Anthropic was raising at, I think, over $300 billion valuation, et cetera, et cetera, et cetera. Like, these valuations are just super strained, super strained. Not to say these aren't interesting companies, not to say that they aren't scaling revenue fast. I mean, apparently OpenAI has scaled to $20 billion a year. It's like the fastest ever to that milestone. Same thing with their valuation. Wonderful. Doesn't justify the degree of pricing that's out there. I think like you just exhaust the money at a certain point. We've seen lots of talk about this kind of round tripping money where you say, okay, well, NVIDIA is going to invest money in OpenAI, which OpenAI will then use to pay for data center capacity for NVIDIA chips and, this sort of thing. I think that's just it sort of maximized itself, and at least for the time being. And I think AI is going to continue to gain adoption through society. It will have all of that stuff is all true, and it's still short-term priced too high. And so the market is going to have to find some sort of an equilibrium in there. Okay, so those are a few different things. I think probably what this means is because of the fact that you will have these sustained higher mineral prices, that's going to be good you can just kind of follow the money, right? And you can say, well, if there is a lot of money going into mining, which is profitable in some place like Chile and Peru, that means that money is going into the economy of Chile and Peru, and other things will rise in that area. Last year, the best performing market was Colombia. Who knows what it will be. I'm definitely not saying the highest performing market will be Chile or Peru this coming year, but these are relatively small economies. It doesn't take that much money to make a meaningful difference there. A little bit like I grew up in a small town where there was a variety of mines. The mines had a lot to do with the local economy. It's just the way that it goes. So the same kind of idea here. There's, to an extent, Mexico has some of the largest silver mines in the world. Mexico is a larger economy, so it does affect it less proportionally, but it still is money going into that environment. Then you can look and you can kind of go through the supply chain. If they're building out new mines, what are you going to see? Companies like Caterpillar are going to benefit. You can already see their stock has gone up a bunch in the last year. So that whole cluster of stuff is likely to play out. I do think there's an interesting trade in buying the miners, in particular copper miners, silver miners. If you can find some good opportunities there, that's probably long-term sustainable, even if the price of copper and silver don't have major moves upward. The reality is the profits of those companies will sustainably be high for a period of time, and they'll be able to scale up production, et cetera, et cetera. So I don't think that is a bad bet at all. And I have not put any money into that bet at this point in time, but I am considering putting some money into some of those indexes. It's not usually how I like to express a view. I have another channel that I created for a kind of co-investing community that I have called investor.net. And so you can go and check that out at some point. So I'll put some videos there about kind of my general investing philosophy around some of this. But in general, I usually like to try and say, what are some high quality names in that area who might benefit? And so with that, let's kind of go over to some of the specific things that have worked and not worked. So probably my best performing individual name this past year was SK Hynix. SK Hynix is a high bandwidth memory producer. I sort of got the idea from Brad Gerstner from Altimeter Capital. I did some research on them, saw they were trading at like 4x forward earnings, which just makes like 0 sense to me, growing super fast. It was just really, really evident that this company should run. And essentially what the deal is there is that traditionally we use a lot of SRAM. SRAM is not high performance. And so for all these AI data centers, et cetera, they need high bandwidth memory. There's a shortage of high bandwidth memory. And so Micron, Samsung, and SK Hynix are the only companies that produce it. And lo and behold, Micron, SK Hynix, Samsung all benefited a lot from this. You could have expressed that view through Micron and done perhaps even better than SK Hynix. The reason I chose SK Hynix was because the valuation was just way, way lower. Like it just obviously was very cheap, whereas Micron was not as obviously cheap. So I figured, okay, let's go and do that. I continue to hold that. I believe there's decent upside. It's up like 200%, almost, not quite 200, but about 200% for me. So very good trade. So there's that. When I did allocations into Euro assets, I went into ASML and Adyen. So ASML is like the epitome of a monopoly. I do think there's concerns with China developing advanced lithography technology of their own, which competes with ASML. But I think you have a pretty decent window of time before that happens. And in the meantime, this is just a behemoth of a company. It was beaten down quite a bit over the last while. And so it performed it's about 40% for the year or so. And so good trade. Happy with that. I continue to hold it. I think it's kind of a long-term quality compounder, which is sort of the objective. Notably, I don't know that SK Hynix is. So if I get enough uplift off SK Hynix, I will sell it. Basically, the idea is that at some point in time, they will produce enough of this that they will basically drive down the margins. Right now, all these companies are allowed to over-earn because of the fact that there's a shortage of high bandwidth memory, and that will not last forever. So I will decide to exit it at some point in the future. We'll see when, and go from there. Adyen is a payment processing company, sort of competitor to Stripe. You can kind of think of that way. Just because of the clients that I deal with and a lot of different business, I know that they're just an insanely high quality company. And so I think they're just a long-term quality compounder. They're down for me, so they have not been a win so far since the time that I bought. And I'm totally fine with that. It's not a like short-term buy, so it's not down a lot. I don't know, maybe 10% or something like that. And so it can easily turn the other way. I may actually add to that position because I just think they're a quality company and they're likely to do fairly well over time. So we've got those. I did a buy, it might have been actually last year in like late 2024, something like that. Probably late mid 2024. It was kind of one that was brought to my attention by a client who used to be the #1 S&P trader in the world. And he had mentioned Pershing Square. Now, quickly, why I would think Pershing Square is an interesting company. So the general idea is, how do I try and do relatively good returns with minimal sort of injection of thought process? And the most basic thing is, how do you beat the S&P 500 without having to worry about trying to like be constantly reevaluating and looking at the portfolio? It turns out there's some like payoffs for me looking at some of these in general, and I do enjoy it. But I don't want to spend a ton of my time. I have other opportunities that are much more valuable. And so the ideal is if you could go back in time and you could just give Warren Buffett your money and just leave it with him and forget about it, he would have done great with it. Now, Warren Buffett, you can't really do that anymore. I wouldn't buy Berkshire Hathaway at this point in time. They've got like a third of their value is in cash. I'm not necessarily sure that I trust Greg Abel to be as good as Warren Buffett. I think they have problems with developing really high returns at scale, et cetera. So you're like, well, who is sort of the next person? And I'd invested, for example, with a good friend in Canada. I will continue investing with him. And so, okay, that's like a little bit of this, but he's not public markets. And so what are the public market things that I can do there? And so I thought, okay, well, maybe we can try this. Pershing Square was trading at about a 35% discount to asset value. Now, it should always trade at somewhat of a discount for a variety of different reasons. This is very normal. So it's not that you would expect that to close 100%, but it is pretty large discount compared to the normal. So you would expect to gain something there. And then on top of this, Bill Ackman tends to be a pretty good investor, pretty flexible. And so, all right, great. Like, let's let Bill Ackman try and do his thing. That's turned out pretty well. My objective there was to hope that he could deliver for us 20% per year, compounded over time. If he can do that, then great. We'll see. I was up about 40%. And so, all right, like perfectly reasonable investment to make. Some bad moves, some mistakes that I have made. So I cut 2 losers. So my worst ever investment was Teladoc. I bought Teladoc when prices of everything had gone down, kind of post 2022, and it looked really cheap, and it still went down a lot. So bad loser, not a good call. What were the things learned from there? So the first most important thing I think is I misunderstood the competition in that environment. I thought that they had much more of a competitive advantage than they did. And so I was kind of bullish on the idea of telehealth. And I didn't realize how easy it is to enter into that space and eat this up. And so I think that was a big problem. There's not kind of founder skin in the game in that situation. I think that's a big mistake. So I try to almost always, not always, but almost always buy companies that are founder led. It's just statistically better. And I think there's a bunch of reasons for that. It's not like you always have to do that. Clearly, Satya Nadella has done an awesome job, for example, with Microsoft. And hey, that was not a founder, right? Similar with Tim Cook under Apple, at least for a period of time. So there's definitely cases where you can have somebody who comes in who does an amazing job, but the bias is towards founder-led companies. So anyway, Teladoc, bad mistake. Fortunately, it was a small position, but it was a loss. We cut it. Another one was eXp Realty. eXp Realty, I went in sort of falsely making the view that it could return to previous all-time highs. It was, again, one that was beaten down a lot. I didn't appreciate, I hadn't done a proper in-depth analysis of what it would take for them to 10x. And I went through later and I did that. I kind of assessed the number of agents and the countries they were in and how many they could pick up and what would that require. And I kind of realized that I was wrong on that. So, okay, mistake, fair enough. Again, not too large of a position, but in each of these cases, I didn't get out early enough. Like what I should have done, I realized that Teladoc was a bad company, over a year ago. I realized that eXp Realty was not a very good company to be in quite a long time ago. But I was sort of holding it on as this sunk cost fallacy, very bad mistake. Again, fortunately, not particularly large positions, but still not good. And so those were ones that's something to learn on. I, in particular with eXp, had a view that there was a particular point on the chart where it looked like it was going to take off. And I was like, okay, great. And then it reversed. It didn't go there. And I should have just cut it at that point. I did not do that. Again, mistake. All right, lesson learned. Off we go. So yeah, that's another. Again, eXp doesn't really have a durable competitive advantage in a bunch of regards, etc. So off we go. I exited Alibaba this year. I exited pretty well. It was about 100%. Well, it was literally 100% gain. So that was a good. I had gone in and bought about a year and a half ago a bunch of Chinese stocks. I figured it was like picking up pennies in front of a freight train for quite a few years. And so the market had been super beaten down, and I thought it had overcorrected the other way. I might have made a video on that, I don't recall, but I went in and bought a variety of different names. And so Alibaba, I exited, did well. Tencent did well. I'm holding Tencent long-term because I think it's a quality compounder. I think Poe is an excellent capital allocator. JD, I should have sold. It was doing very well for me, and then it went down. And so I'm still in profit, but it has not been a good one. I intend to sell it, but just have to figure out kind of the mechanism of exiting and when to exit that one. So that was one there. I had bought a bunch of these Chinese fintech stocks and done super well off them, super, super well. The problem was I had not sized them correctly. They were sized too small, and they were like, you're buying for 1 and 2x multiples with 10% dividends that were growing, that were founder-led, et cetera, et cetera, et cetera. And so 2 of them went up to over 500% return, which is great if it hadn't been a tiny position. Another was up to, I think, like around 200%. And then another one was up, oh, I don't know, 40%, 70%, something like that. They retraced a bunch. So still in profit, but retraced a bunch. And so I've actually added to those positions. I think fundamentally, this is still the case that they will do well. It is worth understanding. So why did they go down? The big reason they went down is because the Chinese government changed regulations. And of course, I knew going in, I was well aware of like all the China risk, right? That was, but the idea when I bought in was I was sitting on a bunch of cash and I said to myself, well, I'm sitting here earning whatever it is, 4% from the bank. I can get into these guys that look insanely cheap and I'm getting 10% dividends. If all I do is sit there and collect the dividends for the next 2 years, I'll have done better than if I was holding cash. And so that was kind of the relative decision that was made. And I think that that's still true. So great, let's hold. So I increased my position slightly in those and we'll continue holding and see how they go over some decent period of time. I have Tesla. Tesla, why did I buy Tesla? I had this kind of, again, the benchmark I think is the S&P 500. You're like, okay, why invest at all? Like, why try to manage my own money if I can't beat the S&P 500? That is the like clear benchmark that you have to compare yourself to, because it's just super easy to buy a low-cost index, the S&P 500, and get back to work, as Warren Buffett would suggest. So the basic mental model I had there, I looked at the stock price and it kind of stabilized. It seemed like kind of reasonable after having gone up a lot and then pulled back, et cetera. And I just said to myself, is the greatest entrepreneur of our age going to beat the S&P 500? Probably yes. Okay, great, bye. Mistake on that, again, was position sizing. I should have sized that much larger. I had actually intended to basically kind of average in, and I got busy, other business and things like this. And as a result, I just never did the subsequent buys. So that position is like, I don't know, maybe a quarter of what the position size should be. Whatever, all good. It's up a lot, and I'll just continue to hold it. It's easy enough given it's a very small position. I missed out. So I have this thing that I call the gambling thesis. What is the gambling thesis all about? The gambling thesis is all about the idea that as you have exploding complexity and scale in the world, which are sort of the 2 leading problems affecting society as far as I'm concerned, you get into a situation where the complexity means it seems that the outputs for the inputs seem more random to people, and the consequences of randomness go up. This incentivizes gambling. The moment you realize this, you can ask yourself, well, if I know that people are going to do more gambling, what is the way to play that and win? And the answer is the house always wins. You want to own the house. And so I first made this play based on buying Coinbase. I'd kind of realized that, okay, crypto is largely millennial gambling. And so great, we want to own the house. The only thing you could really easily buy was Coinbase. Let's buy Coinbase. And so that's done super well for me. I still think that Brian Armstrong is a good CEO and it will probably keep going. What I didn't have the insight to buy, which I should have, was Robinhood. And so Robinhood is, arguably one of the main competitors to Coinbase right now, that one has to monitor that relationship. But I'd seen that Robinhood had started to go up a whole bunch, and I'd kind of missed out on it. And I thought, okay, well, what can I pick that sort of is similar to that? And so I went and I researched and I found a company called, the ticker is Futu, which is sort of Asian Robinhood. I would argue it's not as good as Robinhood, but anyway, that's the sort of idea. So that's done super well. That was a great pick. And I will add to that position. They're growing absurdly fast. And I think kind of the gambling thesis is still in play. And so we'll do that. If there's a good entry on Robinhood, I would probably consider buying it as well. Polymarket was recently raising money in private. I would consider that. And then Hyperliquid on the crypto side is clearly interesting at the right entry point, although one should pay attention to how durable they are. So that's sort of a little bit along that gambling thesis. I own Shopify. It's done super well for me. I think it has kind of a durable advantage, and so I continue to hold it. I think that it has gotten quite expensive. So, growth I would not expect to be what it was. I was buying when it was, I don't remember, like $50 or something, way, way down. So it was a really, really good buy when I was getting in. And so it's up a lot, and that's done great. Unity. So I had been pretty heavy into Unity, and so Unity had gone down a lot. I have a pretty strong thesis around Unity. Largely, my brother works at a major game developer, is super involved in that. And so he and I will discuss the gaming industry. And it just struck me as the most obvious way to make a play into the gaming industry. You're not betting on specific titles. You're not like, oh, let me go and buy Rockstar or, Capcom or Ubisoft or something like this. Over time, it strikes me as very obvious that the companies won't make their own engine. They'll use one of these other engines. I would love to be able to buy Epic Games, Unreal. Tim Sweeney, I think, is a phenomenal CEO, but you can't. They're owned partially, though, through Tencent, and I own Tencent, so that's kind of an indirect exposure. John Riccitiello, I think, is a terrible CEO, and so it's mistakes that were made on Unity. So I'm up quite a bit on Unity, fortunately, but that was not without a good friend of mine who's a great trader, does great returns, mentioned that he does great returns, but it comes with a vomit bag. And so similar sort of thing here. This one was definitely a roller coaster. So I got in probably too high, even though I thought that it was reasonably priced at that price. I probably still do. They went through a bunch of controversy. The price went down a lot. I think you couldn't have really known the controversy, so I don't really fault myself on that side. It was what it was. But the thing that I could have seen that concerned me quite a bit when I dug into it after buying it was the degree of dilution that was happening from share-based compensation. I basically view that John Riccitiello should have been fired a long time before. Again, just terrible, terrible CEO. I don't know how this guy gets job after job in this sort of position, but he does. And so then the question, of course, is like, were they going to put somebody good in, et cetera? They brought in the guy from, one of the senior guys from Zanga, and he seems to be doing okay. When the price was down a lot, I sort of averaged up on that position. And so now I'm up about 50% overall on the position. And I think it will probably continue to do fairly well over time. But one has to monitor because you have this formidable competitor in Epic Games and Tim Sweeney. So, Unreal, I've tried to understand the Unreal engine well and the Unity engine well, and pros and cons and why somebody would choose one versus the other, et cetera. And it's not an ideal situation, because ideally I think I would have some sort of a monopoly product. But that being said, I do think that it could be a little bit like NVIDIA and AMD, where both of them did well. So that's sort of the story there. Okay, so those are a few. What are some other ones? So I have a play on Etsy based on their share buyback. I'm debating cutting that position. I should have exited it. I had a plan to exit at $75. It went up to $77 for a day before they announced they were doing some executive changes, and the market hated it and it dumped down. So we'll see. They also did announce, though, a lot more share buybacks. And so the thesis is just the market cap is sufficiently low and they have sufficiently large share buybacks that it's just going to drive up the share price. And because people know that, reflexivity will kick in, and therefore you get some decent gain. So it's not a massive position that I hold, but that's kind of the basis for that position. What I dislike about it is I just don't think that it is an especially quality company. They are definitely struggling in spite of the fact that they have a pretty good product. And so, it's just not clear to me that you should hold that one long term. I bought Supermicro when it was down a bunch. It started to do fairly well for me, and then it's gone all the way back down. So it's actually at a loss right now for me. I will probably exit it. When I bought in, I thought it was already down a bunch, and I figured that it had more of a competitive advantage than it did. I think that turned out to be wrong. The idea was they have these liquid cooling systems. They basically build out data center. They're required for building out data centers, essentially. And so that was good, right? But it seems like it was easy enough to pivot to Dell as a provider, and so it didn't turn out to be the best bet. I will plan on exiting that company, but I'm not in a huge hurry to get out. So the three names that I have in my portfolio still that I will plan on exiting for sure are JD, Supermicro, and Etsy. It's just a question of when to exit them, etc. A company that I added, so a company that I love a lot, it has done very well for me. It's like doubled. And I think it's just like an absurdly high quality compounder, is Mercado Libre. And so that's kind of when I was distributing my portfolio, I figured, okay, I've got a lot of US concentration. I want something in Southeast Asia. I bought C Limited for that. It's also done very well for me. Mercado Libre in Southeast Asia, or in Latin America. And then I have Well Health in Canada. It's a small position. And I'm not exactly clear why it has not done better. It is basically flat from where I bought it. I thought I bought it at a good price. So we'll see. It's a small enough position. I continue to hold it. The growth rate continues to be really high. I feel like at some point it's got to take off, but it has not. So we will find out how that goes. Anyway, going back to Mercado Libre, I should have sized that position larger. It's done great. I think it's a wonderful company. Basically, what I'll sometimes do is I'll buy a smaller position and I'll use that as a means of studying the company over time. And sometimes I'll exit the position, sometimes I'll end up doubling down on it, etc. So this is one that I've increased the position size, and I will probably increase the position size again, because the more that I've kind of delved into understanding this company, the more I think it's just a super high quality company. And it's one of these things that I'm quite happy to own long term, and I think it will compound for me. The one that I added alongside that is Nubank. Warren Buffett had famously invested in them. It's a Brazilian bank, kind of their version of Revolut, something like that. And they have an interesting competitive advantage, which is they have the lowest cost of any bank in the world to service clients. And so I just see this as like a massive ability to expand into a bunch of these other markets. They're going to Mexico, et cetera. And so I think it's just a wonderful, wonderful company to have in the portfolio. And so we'll see. I may actually double the position I put on initially, but that kind of gives a little bit of an idea. I bought, the ticker is 4475, which is a company in Japan. It was doing quite well for me, and then it's pulled back a bunch, so we'll see. I was not particularly going, it was an attempt to diversify into some quality asset that was yen denominated. That was like basically the overall play in that regard. And I'm just continuing to hold it. It's not a large position. I will use it to kind of explore that company a little bit more and see. The fundamentals to me look strong. So even though the company itself is down, this is kind of where we're at. Outside of that, of course, I own private businesses, and I have some real estate investments, and I have hard money lending. Hard money lending has done like super well for us. We have like some really, really good deals there. They're earning like 34.3% a year, which is nuts. I expect to never do that well again, but time will tell. Maybe we will get lucky and do some of those. But anyway, happy with those. I talk about those a little bit more on investor.net, so you can go over and check that out at some point if you would like. And so that's probably the overall view on the market. I think the other there's a lot of things that you of course don't know. And so one thing might be, what are some of the major risks? I do think it's interesting, the carry trades unwinding. Some people flag this as a major concern. I've tried to understand how large is the yen carry trade? How fast would it unwind? What consequences would that have? It doesn't seem to be catastrophic from what I see. It obviously wouldn't be great. And I guess if it happened super fast, that could be a shock to the system that could be not good. And so there's something there. There's also something to be said that if the US dollar for some reason took a major rapid decline, this could, because commodities are priced in USD, could drive up the price of commodities, which could be bad for inflation. That's sort of an interesting thesis. Obviously, you always have things like war, some of those things. It's hard for me to figure out non-conventional major risks that I see aside from those. So in other words, yes, that you can always have a pandemic. Yes, you can always have a war. Yes, you can, have some major shock event. I don't see that there is really a lot of fragility debt-wise that I'm worried about collapsing. I was having lunch with someone today, and we were discussing a little bit kind of in the very big picture of things, debt issues that need to get resolved. And that's probably true, but I don't think that that's an immediate threat. I see that as relatively unconcerning. One to talk about is Bitcoin. So the market has been very bearish on Bitcoin. So I've been saying since 2020 that I do not believe that the halving drives Bitcoin cycles. And I was a proponent saying that stock to flow was nonsense and all this, and people would argue with me. So I like to take these unpopular positions, and I think that most people are wrong on most of these things. I think they're not reasoning about them particularly well. However, that being said, it is true that Bitcoin had gone through these very predictable 4-year cycles. And so I think a lot of people were holding the view that we're in another 4-year cycle and 2026 is going to be a major down year. I find this hard to believe. So there's a few things that I'm looking at in that regard. And I'll kind of clarify this statement. So I was hosting a variety of investor dinners in Singapore in late September, early October, something like that. And I was kind of making the comment that I figured actually at those prices, it might be better to buy puts on Bitcoin than to buy Bitcoin. And that turned out to have been a good thing. That was also a failure of omission, right? So lots of errors of omission on Michael's side this particular year. Okay, fair enough, whatever, all good. The thing though, so okay, you had this 10-10 crash, crazy liquidation, absurd event. All right, and I do think that alts in general broadly suffer from a lot of supply overhang, and so there's their own issues there. This being said, Bitcoin fear and greed got down to like a crazy level of fear, the type of level that you're talking about getting at like the depths of a bear market, not when you're up at the top. So that's something that I find very interesting. It's not what you would expect for, $80,000 Bitcoin. So basically, I'd kind of, when the market hit 80,000, I messaged some people that I knew and I said, I think risk to reward has shifted, that it's good risk to reward to start buying Bitcoin. And I have a decent sized position of Bitcoin. So, that's, I have some anchoring bias there or whatever. So one has to be a little bit careful about those biases. That's not a statement that I don't think that it can't go down to 74K or whatever, something like that. I just think that the risk to reward over time had flipped at 80,000, that the percentage chance it dropped versus the percentage chance it went up, and especially as you extended the timeline, and the amount of gain that you get from trying to buy lower versus buying at the level that you are is just better. I am not like an obscene Bitcoin bull in the sense that I think you're going to $1 million in the next 4 years. I think this is nonsense. I think all those people will be proven wrong. But I do think that there's a decent chance that Bitcoin is worth, $800,000, $1 million in 10, 15, 20 years, like sometime in that range. And so like there's a decent upswing that is possible in that asset. I also think that because there's to me, there's like a lot of indicators that it has been very sold down, and there's been just a ton of negativity in the market. I think the people who are going to sell have mostly sold. And I think there is this thing that happens where people hold to a particular dogma and then they start to behave almost Pavlovian. And then that dogma gets broken. And I think that's going to happen here. I think that Bitcoin 4-year cycles are going to be proven not to be the case. I think all sorts of people who sold and said, great, I'll see you in October or December or whatever of 2026, those people are going to miss out. Part of the reason that I believe this is because I think it's very difficult in this macro environment to see really low drawdowns. Part of the problem, the reason for this is, first of all, there's just an absurd amount of government spending, which is stimulative to the market overall, okay? Then you're in a situation where you're probably going to have these tariffs reversed. That's stimulative. And you're in a situation where you've got things like no tax on tips and overtime refunds that are going to come in, et cetera. That's stimulative. I think the combination of these things, as well as the fact that it was not that high and that euphoric in general, mean that it's very unlikely we will see a major pull down. I am like deeply the contrarian in this. Most of the people I'm in like groups that we host for so many different companies, and people, I think today or yesterday were posting, they think 30 to 40K. I'm not that person. I'm the odd man out. And I posted on Twitter when we hit around 80K, this view. I have a good friend who trades a lot who's like, I think you're overthinking it. I could be totally wrong. My positioning is in favor of my view, and I could absolutely be proven incorrect. I think it's okay, because I think if one holds for 5 or 10 years, you won't care anyway. So that's like the safety of buying quality assets versus non-quality assets, which is sort of my general view. And just quickly in terms of this, my view is that Bitcoin is basically a religion. So people who are reasoning about it without that, I think, make a mistake. So for example, you've got Kyle Samani from Multicoin Capital, somebody who's a pretty deep thinker about thinking, etc. He basically says Bitcoin is trash, it's, going to zero, etc. I think it's a fun, controversial take to have. I think what Kyle misses is the religion of Bitcoin. I think that he is too focused on utility and adoption and all these other things. And although that often matters, it can be usurped by just this cult-like following, and they just have a cult-like following. There is a marketing machine for Bitcoin that is unpaid, that is just based on all these people who get orange-pilled and off they go. And I don't think you should be delusional about that. I don't think Bitcoin is going to make all these people rich. I don't think the huge returns are going to come the same way that they've come in the past. None of that is the case. But I think that will drive it to be an accretive asset over time. And this means that 5 years from now, Bitcoin is probably quite a bit higher than it is today. And 10 years from now, it'll be much higher than it is today. And so your risk of holding is relatively low. And I think there's a decent chance, though, that the lows or close to the lows are in and that you will have some sort of an upswing. I have seen some people make the statement that they think it will go up to 104 and then collapse down. There's certainly technical reasons to believe that. And so I wouldn't entirely rule it out, but I don't see a lot of catalyst for this happening in the near term. I think it's possible that, 6 months from now, the market looks different and other things are happening. My guess is that by February, you've got some decent enthusiasm coming in. There's a variety of different catalysts that will happen between then and the start of the summer. And you're probably going to see some kind of an uptick, but we'll see. It's anybody's guess. As always, these things are, my projections into the future and might not pay out. I try to think about these things as best I can, but not guaranteed. Now, there's one last thing. And that one last thing is I believe there is an absurd free money trade out there based essentially on the idea that there's just a lot of suckers who are making just like really bad bets, and you can take the other side of that investment. And so that's something I'll do in another video on the investor.net channel. But I think it's just crazy. It's just so asymmetric. I think it's absurd. It doesn't mean that it's without risk. There's always risk, right? Let's not be ridiculous. But to me, I just examine the fundamentals and they're just totally not aligning with reality. So we will see. I will explain it in another video. And so I hope that helps. If you guys have comments, tell me what you think. Tell me I'm an idiot. Tell me that all these are terrible bets. Give me your preferences. Put them in the comments below. And I look forward to seeing you on the next video.